In February 2026, UK specialist lender Market Financial Solutions entered administration. That single event is enough to understand why this case matters far beyond one firm. MFS operated in a part of private credit that depends on trust in underwriting discipline, collateral quality, and governance controls. When a lender in that lane collapses, confidence can evaporate across brokers, borrowers, and funding partners that rely on similar assumptions. Public reporting around the collapse then focused on alleged gaps between expected asset quality and what recovery processes might ultimately realize. The legal process is still active, and final findings will come through courts and administrators, not headlines. But the strategic pattern is already visible. Speed outpaced control, complexity outpaced transparency, and risk signals were treated as manageable until they were not. So this documentary is not a verdict video. It is a control failure post-mortem. We will trace how an apparently scalable lending model accumulated hidden fragility, why oversight failed to stop it early, and what founders and investors should treat as non-negotiable before the next cycle repeats the same mistake.
Market Financial Solutions grew in an era when private lenders could move faster than traditional banks. Its positioning was straightforward: fund property deals that needed speed, flexibility, and structure that mainstream underwriting often could not provide. That value proposition was attractive to borrowers, and it was equally attractive to capital providers searching for yield. As attention and capital accumulated, the business model became more complex. Instead of a clean chain between lender, collateral, and repayment, private credit structures can layer entities, funding sources, and legal wrappers in ways that are hard to evaluate from the outside. Complexity is not automatically misconduct, but it can reduce visibility at exactly the moment stakeholders most need clarity. This is where the early blind spot appears. The market rewarded growth and deal volume, while independent challenge functions often lagged behind operational speed. Governance quality can look adequate during expansion, then prove fragile when stress arrives. In that sense, the origin story is less about one founding narrative and more about a system that prized velocity over verifiability. The next chapter shows how that trade-off looked at peak scale and why confidence stayed high even as structural risk increased beneath the surface.
At peak momentum, the MFS story looked like a private credit success template. Higher speed execution, specialized lending focus, and apparent traction with both borrowers and funding partners. In expansion phases, that combination can create a strong narrative loop. More deals generate more confidence, and more confidence attracts more capital. The risk is that narrative strength can outpace control maturity. When underwriting exceptions become routine and structures become harder to audit, teams can lose a clear line of sight into where the real downside sits. The problem is rarely one dramatic decision. It is usually the accumulation of small tolerances that become normal over time. In practical terms, the rise phase often embeds three vulnerabilities. First, concentration risk can build quietly around counterparties and collateral types. Second, reporting can remain technically compliant, but strategically insufficient for external challenge. Third, incentives can tilt toward preserving origination velocity instead of validating asset quality. That is why the rise matters as much as the collapse. If systems are calibrated for growth optics rather than stress resilience, the eventual trigger does not create weakness. It only exposes weakness that has been compounding for years. The next chapter tracks the trigger point and what surfaced once scrutiny intensified. The crisis phase began when legal and restructuring processes moved from rumor to record. Administration converted uncertainty into hard constraints. Counterparties could not assume continuity, and every major exposure had to be reevaluated under distressed assumptions. In this stage, confidence is no longer priced by narrative, it is priced by recoverability. Public reporting around the case repeatedly referenced allegations involving collateral practices, connected entities, and potential gaps between what was assumed to be secured and what could actually be enforced. Those allegations remain legally consequential and should be treated with precision, but their strategic signal is already clear. Once trust in collateral integrity breaks, liquidity can disappear faster than governance can respond. The reported shortfall and court-ordered asset controls transformed this from a firm-level problem into a market-level warning. Lenders, funds, and regulators were forced to ask the same question at the same time. Where else might controls appear adequate on paper but fail under forensic scrutiny? This is the core inflection point of the MFS breakdown. The trigger was legal and financial, but the underlying mechanism was control fragility accumulated over years. What follows is not just a balance sheet adjustment, it is a full-spectrum aftermath for creditors, employees, and market trust. The fallout is measured in time as much as money. Once a lender enters administration under this level of scrutiny, every stakeholder timeline extends. Recovery slow, legal costs rise, and uncertainty becomes a drag on decision-making far beyond the original firm. For creditors, the central issue becomes recovery hierarchy and asset quality. For counterparties, it is operational continuity while core relationships are repapered or unwound. For employees and customers, the impact is immediate and personal, even when they had no role in strategic decisions that preceded the collapse. At sector level, the consequence is a trust tax. Capital does not leave private credit overnight, but risk appetite gets repriced. Due diligence requirements tighten, reporting demands increase, and transactions that once cleared quickly begin to require deeper legal and collateral validation. That is a rational response to uncertainty, but it also raises frictions for healthy operators. In other words, the damage is not contained to one cap table. It propagates through confidence channels. And when confidence is the substrate of private lending, restoring it requires more than courtroom outcomes. It requires visible upgrades in controls, transparency, and accountability standards. The strategic lesson is not avoid risk. Private credit exists because many worthwhile transactions carry risk that banks cannot or will not absorb. The lesson is to make risk legible before it becomes irreversible. A practical framework has 4 layers. Layer 1 is collateral truth, independent verification standards that cannot be bypassed during growth cycles. Layer 2 is structure transparency, clear visibility into connected entities, control rights, and cash flow paths. Layer 3 is governance challenge, decision bodies with real authority to slow or reject volume when evidence quality degrades. Layer 4 is trigger discipline, predefined escalation rules that activate before liquidity stress becomes a solvency event. What failed in this case, based on current reporting and proceedings, appears less like a single error and more like a system that tolerated ambiguity in critical controls. That is why post-crisis reform cannot be cosmetic. If incentives remain tied mostly to origination speed and short-term yield optics, similar patterns will recur under different names. The opportunity is to reset standards while memories are still fresh. Private credit can remain an essential financing channel, but only if transparency and verification are treated as core product features, not compliance overhead. The final question is simple. In the next cycle, will the market reward speed first or proof first?